So good morning, everyone. Thank you for joining us today for this month's market update call. My name's Connor Stewart. Today we have John Stewart providing another market update. As you see on the screen, please keep your microphones and your cameras turned off. This video will be recorded, so it makes it a lot easier when we're getting the video out to you as quick as possible. We don't have to chop and change too much. If you have any questions today throughout the call, please give us put them through into the chat function as normal. We'll have a Q&A section at the end of the call where John will be able to go through some different things with you. Without further ado, John, are you on the call and ready to go?
Yeah, I hope so. Can you hear me?
Spot on. Yes, perfect. Can you see the presentation okay?
Yeah, perfect. Thank you very much. And if you could please move it on to the first slide, which is the performance slide for the Acumen portfolios. That's where we can kick off.
There we go.
Okay, great. Well, hello everyone. Nice to speak to you again. I guess it's been 2 or 3 weeks since we last spoke, and during the last update, we had the full investment team on the call, which is excellent, and we were able to present our quarterly perspectives for the start of 2021. So this time around, it's just going to be me. I'm going to give a bit of an update on the performance and run through some market slides. I don't intend this to be death by PowerPoint, and I intend to limit myself to around half an hour or so, and then pause, and then that gives us plenty of time, I think, for everyone to get any questions in that they may want to ask. So please send them to Connor throughout. So to kick off, this is the way we usually start. This is an update on performance. So for the month of January, once again, very strong performance across the Acumen portfolios. We were ranked effectively first everywhere, and just missed out and was ranked in the second quartile for Acumen Portfolio 3. So a continuation of very strong performance from the second half of 2020. I didn't actually include this slide last time around, so I thought I'd just provide it this time to provide a bit more colour and granularity. So you can see that over the second half of 2020, we were ranked first quartile in Acumen portfolios 3 through 8, and we just missed out on the top 10 ranking, but we were thereabouts. So couldn't be happier. Excellent job from every member of the investment team. Really strong stuff. If we move on to the next slide, which is the performance slide for the MPS. So this is showing performance inception to date for the MPS, both the vanilla and the ESG, which we launched on the 30th of April. So we're approaching a reasonable track record. We're not like anywhere near 3 years, but we've got a good few months under our belt, and very happy to report the same story. So performance is relative performance is positive against the benchmark, which is excellent. But perhaps more meaningful for many of you, we really perform well against the IA sector as well, both in the ESG vanilla and the ESG. Something to mention here on this slide is I've put in 2 columns. I've put in for the IA sector. One is the existing and one is the new IA sector. So just very briefly, the strategic review for the Acumen funds is getting dangerously close to the end game. The changes are currently with the FCA, and I think yesterday I responded to a number of questions they had. If and when, and it will, that goes through, we will be moving to a new IA sector, and that IA sector will be used across the entire proposition. So Acumen portfolios, MPS, Abacus models, etc., etc. Okay, great. Well, let's move on then. Let's move on to the market update. So, what is the main story to hit markets? The headline news story over the last few months? Well, it's kind of GameStop. But I look at this. I think, in a very different way from the way in which the story has been told thus far. From my perspective, we've seen awful lot of political instability over the last few years. Brexit, the riots on Capitol Hill, which were kind of astonishing. And there's a number of reasons for this, but one of the main reasons is this growing sense of inequality. And that inequality has kind of come out of The process of globalization, where the rich have got richer and the poor have not participated in a lot of the gains that others have, and also the ongoing rise of technology and social media, which has really been turbocharged over the last few years. And if you think about it, especially over the last few months, we really rely on technology and social media during this kind of lockdown era. So not only have we seen this polarization in politics and the rise of left and right-wing parties and the hollowing out of the middle ground, and you can see that in terms of populism with the rise of Donald Trump, or the identity politics you kind of associate with figures than maybe you do more with political parties. So why am I talking about this? Well, I think what's happening is that political instability is spilling over into the financial arena. So what's most interesting about GameStop, I think, is this idea of this democratization of finance. You're getting all of these trading apps popping up, which are commission free. They give it pretty much everyone access who logs on and wants to have so. And most readers will be familiar with Robinhood, who stole from the rich and gave to the poor. Well, that's a great bit of marketing from the founders of Robinhood.com, because they're really tapping into that kind of growing political undercurrent and their stated ambition to democratize finance. And a lot of these investors, the retail investor army, which is kind of who have been participating in driving the share price for GameStop considerably higher, it's not just that they want to make money. If you read the forums, they want to hurt the hedge funds. So very briefly, a lot of hedge funds are short GameStop. They borrowed the stock and they've sold it because they think the share price is going to go down. And the reason for that is it's a bricks and mortar gaming company. Well, that's very much a thing of the past. I remember Blockbuster when I was a kid, driving there with my parents to rent a VHS, not even a DVD. So a lot of people are shorted. They went in there and they were trying to cause as much pain to the elite financial establishment as possible, and of course make money in the process. And look at the moves, absolutely astonishing, both up and in a downward direction. But here's the key point. This democratization of finance story, it's different this time. This is the future. That's nothing new. You saw that in the 1990s. There were adverts for E-Trade commercials, which are, you can participate in this, get involved, and you can watch videos of people, charts that look exactly like this, and then investors going and handing their notice in, and then immediately the stock tanks back down again. So this story isn't new, nor is that this feeling of missing out, that kind of fear of missing out that you get when markets go parabolic and they go off the chart. That's not new either. So I don't see this as the democratization of finance. I see this as the democratization of risk. Retail investors are being given money by governments. They're full of savings. They need somewhere to put it. They can't leave their house, and they are piling it into these high risk names. And that's extremely risky for unsophisticated investors who increasingly can borrow money to try and participate in these gains. To my mind, responsibility for this kind of market mania that we're seeing at the moment and the growing levels of inequality we've seen over the last few years are directly attributable to governments and central banks, namely the Fed. Given the huge levels of stimulus that they provided, it's needed to go somewhere, and we're seeing that playing out in real time. So we're truly living through a historic period. Just to throw out an anecdote or two, the recession we had last year, we continue to have perhaps, is kind of 5 times or so the magnitude of the average recession we've seen since World War II. So it's been a huge hit. More people have been made unemployed in a considerably short space of time than we've seen historically, and yet personal income is at the highest level it's been in around 20 years, despite being in this kind of downturn. So it's a bizarre cocktail of ingredients, and there is no roadmap for this. That's kind of the background for what I want to speak about. Now, all of that unprecedented monetary and fiscal policy I discussed that's been keeping the show on the road, it means that's why we're not queuing up outside banks the way you saw in the 1920s or so, 1930s, sorry. Now, this story kind of tells that. This is a financial conditions index. So financial conditions are primarily comprised of a number of indicators like what short-dated yields, long-dated yields, credit spreads, the value of equities, and the value of the dollar, which is the global reserve currency. When financial conditions are tightening, you're going to run into problems. So the answer to what we've seen with COVID is to keep financial conditions incredibly loose. Now there are two interpretations from this chart. The first one is the white line, which is the Goldman Sachs Financial Conditions Index. It's kind of around all-time lows. You can see on the right-hand side, it's dropped all the way down. So financial conditions have not been this loose in quite some time. Hence, valuations are at extreme levels. Another way of interpreting this chart is to look at the blue or the red line, which is the Bloomberg Financial Conditions Index and the Chicago Fed one. And when you look at those, financial conditions are more or less the same as they were in 2019 or 2018. They might even be slightly tighter. So there are two conclusions from this chart. Either financial conditions are extremely loose, or they're more or less what they were before. And that's a much more worrying proposition, given everything that governments and central banks have done and everything we've seen in markets. If they're no looser than they were in 2019, that could be a problem, could potentially be a problem down the line. I want to focus on the white line, which is the Goldman Sachs Financial Conditions Index, and I'm going to tie it in on this chart to inflation. So this is the year-on-year change in the Goldman Sachs Financial Conditions Index. When the white line goes up, conditions are easing, and when it goes down, they're tightening. Now it's closely correlated with inflation, which is the blue line. Now the blue line hasn't picked up yet. There's a number of reasons for that. One is the numbers are lagged because they're in the real economy, and they are reported on with a delay. But what I think is key here, point number two, is we are seeing signs that markets are doing what they're supposed to be doing, and they are starting to price in a big way over the last few weeks the fact that the blue line is going to pick up, that we are going to see inflation. So what do I mean by that? Equities are back at all-time highs, not just on an absolute basis, like in the US, but relative to long-dated bonds, which you normally invest in when you go through periods of risk aversion. The yield curve is steepening, not just in the US, but everywhere. Commodities are on a tear. And even in Japan, which is the cautionary tale of a country that's been caught in deflation for quite some time, the 10-year government bond yield is not only positive, but it's the highest it's been in 2 years. And if you look at Japanese stocks, the Nikkei 225 is back above 30,000, the first time it's been there in 30 years. So the market is beginning to price in this reflationary impulse, this pickup in inflation. They're pricing in coming out of lockdown. They're pricing in a rampant pickup in the underlying economy, and that disconnect between the underlying fundamentals as they're reported with a lag is extremely wide. Now, our job as fund managers at Tavistock is to adapt to the situation as it's unfolding. And the good news is we've already been transitioning the portfolio to participate in a pickup in the global economy, this kind of reflation trade. We've been doing it over the last few months. We haven't gone too far. We've maintained this balanced approach, this barbell strategy that we discussed last time we had the call, but we are edging in that direction. UK equities, the FTSE 100 is one such position that we've kind of edged into. But fundamentally, other than monitoring markets and saying, all right, well, they're pricing in inflation, we know that the underlying economy needs to pick up. What kind of confidence do we have as fund managers in this story, in this inflation, in this pickup in inflation? This chart, I think, is really important in that regard. This chart shows you the total job openings in the US in orange, and then it shows you total private non-farm payroll, so the official kind of employment figure, as it were. And as you can see, they've moved remarkably closely over time, even off the end of the chart. Now, what is relatively concerning here is that, yes, there's more room for upside in terms of job gains. The white line can catch up with the orange line, but the orange line is still below where it was at its peak, which actually was in 2018, and it's also further below the kind of trend line it had been on since the end of the financial crisis back in 2008, 2009. So this is important because it feeds into what the Fed is doing right now. The Fed has a dual mandate, which is price stability and maximum employment. And as we saw from the last chart, there's not much sign of inflation yet. So Jerome Powell is entirely focused on the employment picture, and he doesn't care much about inflation. He's happy to let inflation overshoot. And he said as much back in August when he came out, and he said, average inflation targeting means we're happy to let inflation overshoot the target for some time. That's now official policy. But more than that, Jerome Powell is super interested in opening the bonnet of the employment picture. And he's increasingly focused on social policy, which arguably is not his remit. He's in charge of monetary policy at the Fed, right? He's not making government policy. But nonetheless, he's out there quoting in press conferences the varying employment levels within different subcategories within the population. So he's highlighted that for Black Americans, the unemployment rate is over 9%, whereas for white Americans, the unemployment rate is below 6%. And he is in no hurry to choke this off. He wants to get back to full employment, but not just at the headline level. He wants to make sure that those parts of the workforce that have been more disadvantaged as a result of COVID and the recession that we're going through, he wants to make sure that they're okay. And that is absolutely admirable. But what does that mean from an economic perspective? It means that we're likely to see rates that will stay lower for longer. But not only is Jay Powell hyper-focused on this employment picture, but so is Biden. Biden is going to come out and he wants to unleash another up to $2 trillion in stimulus. They're both laser focused on employment. And Janet Yellen, who used to be the head of the Fed, who is now Treasury Secretary, is also telling Congress, look, don't worry about overdoing it. We'll worry about that later. You either go hard or you go home. So here's another little anecdote. In 3 months last year, the US increased its deficit by a greater magnitude than the last 5 recessions combined. So we're not just kind of like doing, putting a plaster on it. They are going over and above. That debt will need to be funded somewhere. And historically, our allies overseas would be buying US treasuries, and the US would provide other services, usually security services, etc., etc. We're not in that world anymore because of Donald Trump. And China is one of the largest owners, owns a lot of US treasuries, and relationships with China are not particularly strong right now. Hence, in just around 6 weeks, the Fed ended up buying more treasuries than it did in the entire 10-year period under Ben Bernanke and Janet Yellen, which at the time everyone was really, really worried about. So what I'm saying is, if you're going to be, who's going to be funding all of this extra stimulus and all of this extra debt that the US is going to have to take on to keep the show on the road? Well, increasingly, the stage is set, both politically and economically, for modern monetary theory, which basically means you print money and you just directly fund it. And we don't need to worry about it right now because we've got deflation. So just print the money. And to bring this full circle, and I'll move on to the next slide shortly, Stephanie Kelton wrote a book called The Deficit Myth. Make sure you read it. It's one of the books of probably of our generation. She's also one of the most influential advocates of modern monetary theory. And to pretty much quote her, to the extent that the United States has an unemployment problem, there's too little money in the world. So, I think we're going to see a lot more money to come. I think we need it. I think we're going to see it fiscally. We're going to see it being printed. And that's somewhat breathtaking when you consider the fact that the US money supply, M2, already increased 25% last year. So, anything over and above that is astronomical. I mean, over 20% of all dollars in existence were printed last year. Now, the reason why that hasn't necessarily triggered inflation just yet is because it's caused asset price inflation. It's gone into the financial markets. As this economic recovery picks up pace, and as governments get better at directing money directly to companies and individuals and families rather than going through the system that they've been going through for the last decade, it's going to turbocharge the effectiveness of that money. And as we come out of lockdown, you're going to see the velocity of money picking up, which just means people are going out and actually spending it. So there's more money over here, and there's greater opportunity for it to have an effect. So there's a real risk that the inflation can pick up, and it's our job to be aware of that. And most people are talking about COVID and the vaccines, and are we going to get through this? I'm increasingly focusing our time in the investment team on what happens if inflation picks up far greater than anyone is currently expecting. So that's the key risk. And if that were to happen, it effectively means that the Fed and other central banks, despite their desire to be accommodative and to boost employment, they might have to clamp down on stimulus far faster and harder than anyone is expecting at the moment. This might be a year away, this might be 2 years away, I don't really know, but it's something that's on the horizon. And such a move would be such a surprise to the market, given that at the Fed's most recent summary of economic projections, the median forecast said there'll be no interest rate hikes to 2023. It would potentially cause an issue. So what I want to briefly touch upon now, and I'll move through the next slides at a faster pace than I have the prior ones, is if we do see inflation really, really picking up, and it's definitely the risk to be thinking about right now, at what point might it become a problem and cause equity valuations or other risk assets to fall over and to fall off in value? Well, that's the million-dollar question, right? So there's a few ways we can answer that. One is to look at inflation expectations. So this chart shows you US equities in blue, and it shows you expectations for inflation over the next 10 years in white. And as you can see, they move in tandem, they move together, so there's a positive correlation over time. Although this relationship does break down, and you can see it quite nicely on the chart, I think, every time inflation expectations in white get to around 2.5%, which is in yellow. So you can see on the left-hand side, got to 2.5% equity sell-off. Correlation, inflation expectations get back to 2.5%, move along, you can see the equities sell off. So the first hurdle, perhaps, that we need to be aware of is what happens when inflation expectations get to 2.5%. Well, on the right-hand side of the chart, you can see that the white line isn't at the yellow line, so we're not there yet, but it may not take much to get there. So that's the first kind of hurdle or warning or alert that we need to be aware of, and we need to monitor what happens around that level. Now, there's a good chance that it will be allowed to overshoot, because that's what Jay Powell is saying is going to happen. We're going to let inflation overshoot. But if they feel like inflation is going to get carried away, they will quickly stamp down on it. So that's the first thing we're looking at as a team over a medium-term horizon. The second thing is inflation, right? So forget about inflation expectations. They may not come true. What about actual hard inflation? Well, the magic number, according to Russell Napier, who's a very well-respected financial historian, and I think he set up his own macro strategy kind of shop that I'm looking at the moment. He says 4%. And I think this chart also tells the story quite well. Just focus on the white line. There've only been a few occasions historically where inflation, US CPI inflation, has got to around or above 4%. So the late 1980s, 1996-ish, 2000, 2005, 2007, and 2011. And what's interesting is every time inflation's got to that kind of level, okay, it's overshot on one or two occasions, it's turned around and it's quite precipitously come all the way back down again, usually bringing equities with it on the expectation that the Fed is going to come in and raise interest rates. So 4% inflation seems like quite a far way off from the inflation levels that we're seeing at the moment. But if inflation comes back faster and harder than the market expects, which is the key risk I'm talking about right now, we could get there quicker than we think. And you can see that by looking at the white line and seeing how it moves quite sharpishly in a vertical direction during certain periods historically. So it's not a risk that should be discounted. The next thing is what about nominal yields? What about treasury yields? Because with yields low, it keeps the show on the road. Equities are valued by discounting future earnings by an interest rate, and because interest rates are very low, equity valuations are very high. So as interest rates rise, it erodes that kind of growth number, and it causes equity markets to come off. We've seen that time and time again. So this chart is really interesting. It's really simple, actually. What it basically says is treasury yields and equities can move in the same direction, right? So if you're thinking about the early start of a recovery, inflation starting to pick up, interest rates are starting to pick up, that's good for equities, right? Because they're all moving in the same direction. They have a positive correlation. But sooner or later, you get to a choke point or a pinch point or some kind of transition period where interest rates get to a level, and anything above that, the market goes, oh, they're a bit higher. I'm not sure I like equities quite as much as I did before for the reasons I mentioned. Well, historically, if you look at 1963 to 2011, the grey dots, that transition between higher rates is good for equities to higher rates is bad for equities, that switch has happened around 5%. And you can see that because the grey, that's the point where the grey dots go from being positive to being below the line, to being negative. After 2012, from 2012 to 2019, they're the orange dots. So actually that flip point is kind of around 3%. And we haven't got data fully for it in 2020 to 2021. They're the blue dots. But I think arguably what's that saying, because they're all on the left, they're on the left-hand side, is it might well be below 3%, right? So let's just say somewhere between 2% and 3% for 10-year Treasury yield. It's going to rise to that level. That might be the pressure point where equities come under pressure. Now that's very much in keeping with one of my favorite charts that I think I used this in October, November. I bring it out every few months and hope that people forget I used it before. But I love it because it kind of just shows you how like everything moves within a range. This is market psychology on a chart for you. We made the call a good few months ago that Treasury yields were going to rise and the yield curve was going to steepen. We sold our 20-year Treasury position. We're entirely positioned at the front end of the curve. Part of the reason why Acumen Portfolio 3, which is bond heavy, is doing so well is because we don't have exposure to the fact that long-dated bonds are losing money right now, and they're losing money at quite a rate. And you can see that by that kind of pickup in the white line on the right-hand side. But the reason I've included this chart here is because historically, you can see that the 10-year Treasury should get to around 2%-ish, and that would be the top of its usual trading range. But actually 3%, which is the orange line, is the overshoot level. Historically, it's got to around 3%, and that's it. And then it's come back down again. So these numbers are consistent with what I was talking about in the prior slide. Treasury yields can rise to around between 2% and 3%, and that's normal. But anything beyond that level is where you might start to see risk assets coming under pressure. Where are we? 10:30, right? I think I can wrap things up in the next 5 minutes. Now, real yields are a combination of inflation or inflation expectations and nominal yields. So the same charts I said before, but we're just wrapping it up into one graph, one picture. So real yields here are in blue, and here I've put on the price earnings multiple for US equities. So how much you're willing to pay for earnings that the companies generate. And you can see there's a good correlation over time. Now, this chart is interesting because it tells two things, really. It basically says that the white line, the price earnings multiple, should probably be a bit higher, right? If real yields stay where they are, which is minus 1%, price earnings multiple can be higher. So we can easily see this melt up. We can see this frothy equity market that I've been describing continue to go higher for a bit. That's the first conclusion from this chart. Let's flip that around and focus on what I've been discussing on the last few slides. It also says that real yields can probably rise by about 30, 40 basis points before we see US equities maybe coming under pressure. So this is something we're monitoring as well. It's kind of one of the key risk factors. If we see the blue line move down to the white line and go through it, maybe we're going to get a period where equities are once again, or risk assets once again, are under stress. And that story that I just said, which is, all right, we're frothy, we're nuanced in our approach to risk, but nonetheless, this risk rally can continue to go higher for a little bit further. It's the same story we mentioned 2-3 weeks ago in the quarterly perspectives call. This was the chart of the quarter. The red line is the price earnings multiple. It's a slightly different version of it, but it's more or less the same thing. And it's the same thing. Yes, they're expensive, but historically they can get a bit more expensive and rise to the grey line. And actually anything beyond the grey line is pure bubble territory, like we saw in the late 1920s and like we saw in the late 1990s for the tech bubble. So to summarize, it's going to take quite some doing to break us out of, and that's an understatement, to break us out of this disinflationary, deflationary tech companies, Amazon bringing price down, out of this disinflationary world we've been in for some time. But for the first time in quite some time, the risks are increasingly skewed because of this focus on employment, and not looking at financial stability risk like GameStop, and not looking at inflation, the risks are skewed that we could see a real pickup in inflation, and it could come through faster and harder than markets currently expect. So we have a roadmap within the investment team. We're very conscious and aware of this risk on a medium-term basis, and it features into our investment decision-making process. That's kind of the end. I'm just going to run through the next few charts very quickly because that'll take me to 10:35. When I was discussing the financial conditions index, I mentioned the key components within it, and it's important that index stays loose. Now, the Goldman Sachs index that I was referencing, we think it has a higher allocation to the dollar than the other ones, which is why it was so obviously different. So what is happening with the US dollar? Well, we got some really good calls early last year, and actually around the middle of last year, with the dollar index, the value of the US dollar really falling. We continue to think that the US dollar could fall over a medium-term basis by 20 to 30%, and that'd be great for risk assets. But we're very conscious of the fact that the market is positioned in one direction. Almost everyone thinks the dollar is going to weaken. And that's usually a contrarian indicator that maybe things could snap back a little. And then you've got this chart here, which basically shows you at the bottom, every time that white line breaks above a yellow line, it means we think something's going to happen based on statistics. It's the Bollinger Bandwidth. And you can see historically, every time the white line moved with the yellow line, the dollar jumped in 2008-ish. It jumped in 2014. And we've had a similar kind of breakout around the second half of 2020, but and the dollar kind of bounced a bit, but actually it fell back down again. And now we're at this key level where it's almost like, are we going to continue to fall after this period of pause, but a very unconvincing rebound in the dollar, or are we actually going to see something snapped back? And if that does happen, that can have dramatic effects for the broader market as a whole. So bringing the conversation in from the medium term to kind of stuff we're looking at on a more near-term basis, that's something that's front and foremost of our minds. And yeah, I think this chart is a nice way to end it, which is, we've been on a really good run. All of your clients have made an awful lot of money, hopefully because it's all invested in our Acumen portfolios, or the broader CIP range, including the MPS and Abacus models, which I can discuss in the Q&A section. But is this as good as it gets? So going back to 1980, this is the US ISM manufacturing PMI. So it's kind of what do you think about the future, and are you reflecting that in your purchasing decisions as a business? And anything over 50 is optimistic, and anything below 50 is kind of like we're not that excited about the future. Well, we would just come off what you can consider historically to be a very, very optimistic reading. And actually, very rarely does that level of optimism exceed the yellow line, which is where we are. And actually, it usually falls down. And I've superimposed on here the 30-year Treasury yield because when the white line falls, typically the blue line has fallen as well, which means yields are falling, which means that long-dated treasuries are rallying, which means risk aversion in markets. Things are different this time because of the debt levels, and you can see the blue line isn't where the white line is. So things are very different now, which is, there's no roadmap for this, but we've got to be really careful because maybe this is as good as it gets. My personal view is this chart doesn't truly reflect the underlying economy. This chart is a second derivative because it reflects people's views of the economy and how they are reflecting that in their purchasing decisions. So actually, you could see the white line bouncing along the yellow line for a bit as the underlying economy continues to pick up speed. So it's not necessarily as bearish as it might look at face value, but it tells the story I wanted to say, which is, we're not out of the woods just yet.